Tomorrow morning at 8:30 a.m. Eastern, a single number drops. And depending on what that number says, mortgage rates could move higher. The Fed's next decision gets clearer, and the stock market opens in a completely different direction. The June jobs report, released Thursday, July 2nd. Economists are expecting somewhere between 87,000 and 115,000 new jobs added in June. That is a massive range, and the reason the range is so wide is exactly why this particular report matters more than the last few. Bank of America put it directly. If the number comes in strong, it will likely push the Fed toward the 3 rate hikes they've been calling for in 2026. 3 rate hikes, on a Fed funds rate already sitting at 3.5 to 3.75%. That means higher mortgage rates, higher credit card rates, and a savings rate environment that could actually work in your favor if your money is in the right place. Today, on the exact halfway point of 2026, we're going to walk through what to expect from tomorrow's report, what it means for every major financial decision you might be making in the second half of this year, and the mid-year financial review that every person watching this should run before the end of this week. Names why most people ignore these moments. Here's the honest reason most people tune out when they hear the words jobs report. It sounds like macroeconomics, like something for traders and Wall Street analysts, not for someone trying to figure out whether to pay down debt or build savings or buy a house. But here's what makes this particular report different from a typical monthly data release. We are at a genuine inflection point. The Fed has held rates steady. Inflation is running above target at 4.2% in May. And the jobs market has been sending mixed signals all year. Strong headline numbers, but softening underneath. U.S. Bank's June 2026 economic outlook described the labor market as having defensive stability. Hiring is modest, household purchasing power is waning, and consumer spending strength is now more closely tied to wealth than to real income growth, which suggests rising fragility and a narrower margin for error. That is not a description of a comfortable economy. It's a description of one where one bad data point can shift the entire second half of 2026. Tomorrow's number is that data point. Here's what's actually in the jobs report and why each piece matters for your wallet specifically. The headline number is non-farm payrolls, how many jobs the U.S. economy added or lost in June. May's report showed 172,000 jobs added, with gains concentrated in leisure and hospitality, local government, and healthcare, while financial activities declined. Economists now expect June to show somewhere between 87,000 and 115,000 jobs, a meaningful step down from May, reflecting the likelihood that May's leisure and hospitality surge was partly driven by one-time World Cup and Memorial Day timing effects that won't repeat. The unemployment rate is expected to remain at 4.3%, though some economists say continued household employment strength could push it down to 4.2%. Here's why the range between 87,000 and 115,000 matters so much more than usual. At Bank of America, economists say a strong report would likely push markets toward their call for 3 Fed rate hikes in 2026. The downside labor risks that prompted last year's rate cuts have not materialized. Combined with sticky inflation, that strengthens the case for reversing those cuts. 3 rate hikes, from a Fed that was expected to be cutting rates just 6 months ago. If tomorrow's number lands above expectations, that scenario becomes more likely. Every financial product tied to interest rates moves in response, immediately. Remember those 3 things from the beginning? Mortgage rates, the Fed's next decision, and the stock market's direction? All three get clearer, in one direction or the other, at 8:30 tomorrow morning. Let's walk through the two most likely scenarios, and what each one means practically. Scenario 1. The report comes in strong, above 115,000 jobs. Unemployment holds or drops. This is the Bank of America scenario. It strengthens the case for rate hikes. Mortgage rates, currently at 6.26% on a 30-year fixed, could move higher in the days that follow. If you're actively shopping for a home or considering a refinance, a strong number is a signal to move quickly rather than waiting for rates to improve. For savings accounts and CDs, a rate hike environment is actually positive. The best CD rates today are already up to 4.40% APY, and high-yield savings accounts remain well above historical norms. If the Fed moves toward hiking, those rates climb further. Money sitting in a standard big bank account earning next to nothing misses this entirely. Scenario 2. The report comes in weak, below 87,000 jobs. Unemployment ticks up. This flips the picture. A weak number reduces the pressure on the Fed to hike, and potentially reopens the door to rate cuts later in 2026. Mortgage rates could ease. Stock markets, which have been rallying to new highs this week, might give back some gains as recession concerns resurface. U.S. Bank maintains a 30% 12-month recession probability, noting that sustained energy price rises above $130 a barrel and thinning household buffers pose real downside risks. Neither scenario is certain. That's the point. The report tomorrow adds meaningful information to a picture that has been genuinely unclear all year. Today is July 1st, the exact halfway point of 2026. And regardless of what tomorrow's jobs report says, this is the single best day of the year to run a quick financial audit on yourself. Yahoo Finance's senior columnist specifically called out today as the moment to do a mid-year financial review, with key steps to keep financial goals on track for the second half of the year. Here are the 5 things worth checking before this weekend. Check 1. Where is your savings rate sitting right now, compared to where you planned it to be at the start of the year? If inflation ate more of your budget than expected, and for most people it did, your savings rate has likely drifted below your target. This is the moment to recalibrate, not December. Check 2. Is your emergency fund fully funded? 3 to 6 months of essential expenses in a high-yield savings account earning 4% or better. If the jobs market softens in the second half of the year, that fund is the difference between a setback and a financial emergency. Check 3. Are you on track with your retirement contributions? The 401k limit for 2026 is $23,500. The Roth IRA limit is $7,500. If you're planning to max either one this year, you're now halfway through the calendar and should be roughly halfway to those limits. If you're behind, increasing your contribution rate now gives the back half of the year to catch up. Check 4. If you have any variable rate debt, a HELOC, an adjustable rate mortgage, a variable personal loan, consider what a rate hike would do to your payment. If tomorrow's strong jobs number pushes the Fed toward hiking, variable rates move quickly. Knowing your exposure now, before it happens, puts you in a position to act rather than react. Check 5. And this is the one most people skip entirely. Review your biggest financial decision from the first half of 2026 and ask honestly whether it still makes sense in the current environment. Did you take on a car loan when rates were slightly lower? Did you open a CD at a rate that may soon look less competitive if the Fed hikes? Did you hold off on buying a home expecting rates to fall? And are they now potentially moving higher instead? The mid-year point is when the assumptions you made in January get tested against the reality of what actually happened. That review is not comfortable. It is also how you avoid making the same assumption for another 6 months, when the picture has clearly changed. Tomorrow morning tells you something real about where the second half of 2026 is headed. Today tells you whether you're positioned to handle either outcome. Those are two different questions, and the second one is entirely within your control right now. Here's where things stand. The June jobs report drops at 8:30 tomorrow morning. Economists expect 87,000 to 115,000 new jobs added, with unemployment holding at 4.3%. A strong number pushes the Fed toward rate hikes and moves mortgage rates higher. A weak number reopens the door to cuts and raises recession concerns. Both scenarios move financial products that directly affect your wallet. Today, the exact halfway point of 2026, is the best day of the year to run a quick financial audit. Check your savings rate, emergency fund, retirement contributions, variable rate debt exposure, and whether your first half assumptions still hold in the second half. You cannot control what the number says tomorrow morning. You can control whether you're ready for it. If this video helped you think about your money more clearly today, hit that subscribe button. Every week on First Million Club, we break down exactly these kinds of real money moments with real numbers, so the economic headlines stop being noise and start being useful.